Hey everyone, I'm Robert Leonard. I am the VP of Growth at the Investors Podcast Network, and I also host two podcasts at TIP. In this video, we are going to be going over the intrinsic value of AutoZone. This is the companion video to the AutoZone intrinsic value on the TIP website. We're doing a dive into the tools that I've used to gather all the data and how I did my analysis for the DCF model and basically just all of the resources that I used for creating this analysis for AutoZone. So I'm going to be writing a new IVA, which is an intrinsic value assessment, every 2 weeks on the TIP website. When we started this, I knew I wanted to do Square for the first one. It's one of my favorite companies. And so I knew for the first video and the first analysis, I wanted it to be Square. When it came time for the second one, I wasn't sure which company I wanted to analyze. So I used the TIP filter tool to do this. And so we're going to walk through how I found AutoZone and decided to analyze it for this week's intrinsic value assessment. But before we get to that, I want to show you how to even get to this analysis. So if you just go to theinvestorspodcast.com, and then you click on Academy and then Resources, it's going to bring you to a page that looks just like this one. And if you scroll down, you can see under Resources, you will see View all of the intrinsic value assessments. If you click on that, it will bring you to a page that looks just like this one here. And you can see this will always have the latest intrinsic value assessment. So in this case, it's AutoZone. You can also see our top performing intrinsic value assessments. And then if you scroll down a little bit more, you can see all of the other ones that we've done. And it's in chronological order. So Square was the one before this, H&R Block, so on and so forth if you continue down. So these are all of the intrinsic value assessments that we've written so far. So we're going to go over AutoZone. You can click on Read the Full Assessment here to actually get into the full analysis and the article. Once you do that, it'll bring you to a screen that looks just like this. And we'll walk through all of this data and how I got it and how I used the TIP finance tool to do that. Like I mentioned at the beginning of the video, I didn't know which company I wanted to analyze. I knew with Square, so that one was easy. But when it came to the next week, I wasn't sure. And so I went to TIP Finance. You click right here and go to Finance, and it'll open the TIP Finance tool. And you do need to subscribe. So if you don't have a membership yet, make sure you subscribe and get access to the TIP Finance tool. Once you do that, it's going to bring you to a page that looks like this. Once you get to the TIP Finance tool as a whole, you just click on Filter. It'll bring you to a page that looks like this. I went through large cap, mid cap, and small cap. And I was going through all of these different companies to decide which one I wanted to analyze. And when I was going through the list, I was focused on the sector because Warren Buffett talks about investing within your circle of competency. And there's some sectors that I understand and there's some sectors that I don't. And so I thought that would be the first way that I would narrow it down. I understand financial services companies because it's actually probably one of the companies I understand best, but I didn't want to cover those yet in an intrinsic value assessment. They're analyzed quite a bit differently using different metrics than traditional companies. So I figure I might do one of those a little bit later, but I didn't want to do that for the second one. So if I saw financial services, I pretty much just excluded it. And then technology was a sector that I am interested in, but it's one that I don't know great. And Norton LifeLock was actually a company that I did consider before choosing AutoZone. So we might do one on Norton LifeLock eventually. And if you want to see one on Norton LifeLock, comment below in the video and let me know that you want to see that, and I'll do that. I also looked at this one here. It's a consumer cyclical business. I've never heard of the company, so I don't know the company itself, but it was interesting to me. So we might cover this in a future one as well. Another one was Aflac. That was interesting. And I kept going through, again, mostly ignoring financial services and then looking at the sector. And then if it was a sector I knew I could understand, I would then look at the company to see if I knew the company at all, to see if it would be worth me diving into, because I wanted to look into a company that I had a little bit of an understanding of. And so there was a bunch that we could have looked at. Another one here was Markel. I like Markel a lot. We might cover that one in a future episode. But basically, I kept continuing to go through. To eBay was another one, Progressive, Whirlpool, all of these companies that we might potentially look at in the future. So I continued to go through the sector and look for some of the names. And ultimately, I ended up deciding on AutoZone, which you can see right here. AutoZone, the company, ticker AZO. I chose AutoZone because I understand the business. I'm actually a customer of the business. I've bought in parts there, gone to the stores. And so I feel like I have a good understanding of their business model. And I could even do boots on the ground research like Peter Lynch would recommend in his book, One Up on Wall Street. So I ended up going with AutoZone. It had a good potential yield. TIP finance tool will automatically look at the cash flows of the business and its EBITDA and its enterprise value and its market cap and make a calculation of what the potential yield could be using historical data. Now, this is not necessarily guaranteed by any means, but it gives you a general idea of what you might be able to expect from a company. And so 7% return with a TIP median multiple of 10.7 and a TIP multiple of 14.2. All of it seemed pretty reasonable. And given that I understand the business, I thought it would be a good one to dive into. I also like that the momentum was green. And so that's going to add to a piece of the analysis that we will talk about a little bit later. The reason I wanted to talk about this is because you can use the TIP finance tool to actually do your analysis, which we'll get into in just a minute, but you can even use it to find companies to potentially analyze. It has its own filtering tool. If you've used any stock filters before, it can do that as well. At the time of the writing, its market cap is just about 27 billion. Its revenues and cash flows for the fiscal year of 2020 were 12.6 billion and 2.3 billion respectively. Currently trades at about $1,200 per share with a 52-week low of $685 and a 52-week high of about $1,300. And so if we want to dive into the specifics of AutoZone, you could just click on the company here. And when you click on that, it's going to bring you to the TIP Fundamentals tab. So we were on the filter tab before. It's going to bring you to the Fundamentals tab. And it'll give you all of this information here. It'll give you all of its financial statements. It'll give you some key ratios. And then this is where we'll calculate our intrinsic value. But I mentioned the 52-week high, 52-week low, market cap, things like that. So you can use this chart right here to get that data. And then we talked about revenue and cash flow. The revenue numbers come from right here. And then the free cash flow number comes from right here. We are going to first look at its cash flows. One of the reasons why I like this business is because you can see, I'm going to go back to the intrinsic value assessment here. We can see that the cash flows are pretty stable. They're a pretty stable business. 2017 came and they started to grow a little bit. It looks like they've about doubled their cash flow from 2017 to just about 2020 or so. And so relatively stable business, which means we should be able to relatively accurately be able to forecast the data. With a company like Square or other high-tech growth companies, it's often hard to forecast out when they have so much growth. With something like this, we're probably not going to be exactly right, but we can probably get a general idea and probably be more accurate with a company like this than you can with a high-growth company. So that was the other piece about AutoZone that I liked and one of the reasons why I wanted to look into it. Now, let's go into, if you read through the article, I looked at 3 potential DCF models for AutoZone. And the reason I did that is because as I went through and I researched about the company, and you might know this just intuitively, but they provide parts for automobiles, typically vehicles. They're providing parts and service to customers. And that industry, I would argue, is ripe for disruption. There's a lot of competition. And so there's a lot of risk with a company like this. Sometimes that makes for a great investment opportunity, but sometimes you could also invest in a company that is eventually on its decline. We could think of, sports retailers and, like Modell's and Sports Authority and some other companies that operated in an industry different than this, but similar in the sense that they had competition and were being disrupted. Because of that, I didn't want to run just one DCF model. If we just ran one DCF model and we got, typically a DCF model, a lot of times, at least for me and a lot of new investors, I see that they use really optimistic input data, which has a huge impact on the future value of the stock. And I know that's a bias that I have and investors have. So rather than falling victim to that, I decided I wanted to do 3 potential models here so we'd have a range of returns rather than saying we're confident that over the next 10 years, we're going to get 11.9% return. Although that 11.9% return takes into account 3 different potential situations with different growths and likelihoods. I wanted to take it even further and say that there was a potential range of even returns rather than specific growth. So that's why I chose to use 3 different DCF models. Let's walk through the first one here. So the first one, I said that it's probably the most optimistic. It's definitely possible, and it is based on sound logic. And, I could make an argument that this situation right here is possible for AutoZone. In order for them to achieve this outcome, they're going to need to fire on all cylinders, not have much impact from competitors or the other risks that talk about in the article. And if that's the case, I think they could grow at 10%. I think there's a 15% chance they could grow at 10%. And then there's a 60% chance that they'll grow at about 6%. And then a 25% chance they'll grow at about 3%. I used their trailing 12 months of free cash flow. I adjusted it. So you can see here, if we go back to the TIP fundamentals, you can see that their free cash flow for the last fiscal year was 2274. But over the last trailing 12 months, they've done 2496. So again, being a little bit optimistic, I chose to start there with my data point. And so if we do that, you end up getting a return of 11.9%. Now, if we look at the second scenario, it takes into consideration more realistically, I think, the opportunities and the risks that are facing AutoZone. I think it takes into consideration some of the possibility that the business actually is eroded away by competitors and some of the other risks. And so you can see the growth rate for the upper band decreased from 10% to 5%, but the likelihood went up to 25%. The middle possibility, or the most likely situation in this case, was 3% growth, which is pretty much just growing with the economy, more or less, 50% likelihood of that. And then the lower band is a 0% growth rate with a 25% likelihood. So I think that this is probably pretty well balanced in terms of what's going to happen. I would argue that this is probably the most likely scenario, and this resulted in an 8.74% return. And also in this scenario, I did not adjust the free cash flow. So I just left it at whatever their last fiscal year was, which is the 2274 rather than the 2496 that we used here. So that's even a little bit more, not pessimistic, but it's just probably a little bit more realistic. And that's partially why, in addition to the different growth rates and likelihoods, that's what played into a slightly lower expected return. And then in the third situation, I consider this probably the worst case scenario for AutoZone. Of course, things could always be worse than we expect, but generally speaking, I think that this is probably the worst case we'll see unless there's major disruption. And so in this scenario, I basically said they'll have no growth over the next 10 years. And I said that there's probably about a 25% chance that that happens in a worst case scenario. And then the middle would be a negative 3% growth with a 50% chance of occurring. And then the lower band would be a negative 5% growth with a 25% chance of happening. And again, I did not adjust the free cash flows here. And this reduced the expected return from 11.9 that we saw in the most optimistic situation, from the 8.74 that we saw in the middle or most likely situation, and then to 5.9 here in probably the worst case scenario that would probably happen for AutoZone as a business. Now, there are a lot of different things that could go into this. The multiples can contract. So maybe we're even right on the cash flow. Maybe this worst case scenario is exactly right, but maybe multiples contract. Maybe it's trading at 15 times earnings today. And even though we're right about this cash flow, maybe in the future it ends up only trading at 8 times earnings. And then that would have a negative impact on the stock. So for me, rather than picking one of these situations and saying, I'm confident that this is going to be my expected return over the next 10 years, I personally, in this case, like to say over the next 10 years, our return will likely be somewhere between 5.29%, which is the worst case scenario, and 11.9%, which is our best case scenario. The likelihood of it falling within there, I think, is probably pretty good. And so that's why I chose to use the range of potential returns. And so now I want to show you exactly how I use the TIP Finance tool to do this analysis. So go back to the TIP Finance tool, go under Fundamentals. And when you're on this screen, right here on the intrinsic value box, again, you could see when we were looking at the TIP filter here, you could see that the simple yield was 7.04%. And you can compare that to the S&P 500 or the 10-year Treasury. But to do your own analysis, just click on this little calculator here, and a box is going to pop up, and it's going to look just like the box that you see in the intrinsic value assessment. And we're recording this video a little bit after the article was written, so you'll see the current market price is slightly different, and that will have a slight impact on the expected return here. But you can see that the tool automatically saved the input variables that I had. This 0% growth with a 25% likelihood, so on. This is the data that I used for the worst case scenario, if you remember. So all you have to do is enter in your growth rate that you expect here and the likelihood that you think that that will happen. And this would be the highest you expect it to grow. This would be the most likely that you expect it to grow. And this would be the lowest you expect it to grow. And then you put in the likelihood for each one. And again, you could adjust the cash flows. So in this case, I did not adjust it. But if you think that in 2021, they're going to fall from this about 2.2 million or 2,200 point, you could adjust this down to say 1,500. And you can see that the tool will automatically change your starting point. And so your starting point is going to be a big factor because, we see it cash flow increasing. If they end up falling back, this from 2019 to 2020, they grew a lot. And so if you use this as your takeoff point, you're starting quite high. But if they end up falling back more towards their norm or their historical average, and you start here, you're going to way overvalue the company. And so you just want to make sure that your starting point is realistic. And this chart looks like they grew a lot in 1 year, and they did, but I'm okay with using this as a starting point. If you want to be a little bit more conservative, you could potentially pull it back to maybe 1800. But what's great is the TIP tool allows you to do that. And when you do that, you could see that the return changes automatically. So you could do these what if analysis to say, okay, well, if maybe we start off in 2021 at this point rather than where they left off in 2020, this is how my potential return could be impacted. And you could do the same here. So we're expecting zero growth, but for illustration purposes, I don't think that this would actually happen. But just to show how the TIP tool works, if we assume that they could grow at 100%, see the graph changes and we can see our expected return goes up to 57%. Of course, that's not realistic, but it shows how the tool can work. Maybe we adjust it to 30%. You can see again, it just automatically changes. Now, one of my favorite pieces of the TIP finance tool is how we can adjust the current market price. And so right now, this is what the stock is trading at, $1,189.86. And if our assumptions prove true in that we've put in the model and we hold for 10 years, our expected return is 5.45%. That is not guaranteed, but that's our expected return based on cash flow. But what if we ended up buying the stock? What if the stock has a massive pullback? A lot of people think stocks are frothy right now. What if we saw a 50% pullback in a company like this? So what if instead of trading at almost 1200, it went to 600? What would our return go to? Well, if we were able to buy at 600 and all of our input variables proved true, we could expect a return of almost 14%. It would be 13.93%. And so that illustrates how important your purchase price is. The lower you buy, the higher expected yield you're going to get, assuming that your data and your input variables prove true. And you can just hit the revert button here, and it will bring you right back to the current share price of the stock. And also, if you have a subscription to TIP Finance, you can save your data, which is awesome because now I can go back to this and see what I had for my input. So if you just click yes, it'll say, do you want to save your changes? If you just hit yes, it'll save that. So next time you come into AutoZone in your TIP Finance account, you'll be able to have that data already there for you. As I work through the rest of my analysis, as value investors look to fundamentals a lot in their financial statements. And so this right here, I got pretty much all of the data I needed from a high level, gives me all of the major categories, and it also gives me 4 of the great key ratios that we like to look at. If you want to dive in a little bit deeper, you can click on these arrows here, and it'll bring you to an even more detailed view of the financial statements, income statement, balance sheet, and cash flows. You can change it from annual to quarterly. You can change it from dollar amount to percentages, and you could play around with this. It gives you your earnings per share, shares outstanding, gives you all of the data you need for your analysis, both on income statement, balance sheet, and your cash flow. So when I'm going through all of the analysis for the intrinsic value assessment, this is what I'm using as my source of financial data. And then the last piece I want to chat about is the momentum component. So if you click on momentum here, it'll bring you to another filter where you can look at the momentum of other stocks, but I want to look at the momentum of AutoZone. So you click the green here, and it's going to open a new page under the TIP momentum section. And when you click on that green momentum status, it'll bring you to a screen that looks just like this. You can see the momentum feature of the TIP Finance tool, and we can see that it's a green status. And so this tells me that I probably am not buying into a falling knife, at least at this point. So with a company like AutoZone, a lot of times the problem is it looks great on a financial basis. So you look at the fundamentals and you do an analysis of your potential return and it looks great. But a lot of times what happens is you end up buying into a falling knife because the reason it's priced the way it is because there's expected risks and headwinds for the business. And that's already priced into the stock. And so sometimes when you're buying a company that seems great on a numbers basis, you're not considering the qualitative piece of the business and the stock continue to decline even though you think it's undervalued. So what the momentum tool does is it helps you avoid falling knives, and it helps you know that this stock has a momentum status that is green, which means it's positive. And so with a company like AutoZone, I like to use the momentum tool, and you'll see this green momentum status on all the different tabs. And so when we were on the TIP filter screen here, anytime you see the green dot or circle, if you click on it, it'll bring you to the TIP momentum feature, and you can look at the same data. So there's a bunch of different ways that you can get to it. You can just click on the circle and it'll get you to a screen that looks just like this. And so that's why I like to use momentum. That's why I think there's so much value in the momentum piece of the TIP finance tool. And that pretty much walks through how I use the TIP finance tool for this entire analysis that you see here for AutoZone. I just want to remind you that these are my general thoughts. I'm not your specific financial advisor. I don't know your specific situation. This is not investing advice. And there is a disclosure in the article, but just remember that I'm not recommending you do buy AutoZone or you don't buy it. Make sure you do your own due diligence, figure out what's best for your situation. What's more important is learning how I use these tools and how I analyze these businesses so you can then apply that to your portfolio. So rather than saying, oh, I should or shouldn't buy AutoZone, what you can take from this video is that you can learn how to use the TIP finance tool, apply that to your investing, and then make investment decisions that way. And so that's how I would encourage you to do this rather than looking for specific stock picks. All right, so that's it for this video. If you are interested in the TIP finance tool, just go to theinvestorspodcast.com and it'll bring you to the homepage and click on finance, or you can go to theinvestorspodcast.com/TIP finance. And we will put a link to TIP Finance, the Intrinsic Value Assessment, and you can also connect with me on social media. All of those links will be below in the description. If you guys have any questions about the analysis or the video, please feel free to follow up with me on social media. I'm most active on Instagram, or you can send me an email as well. And I will see you guys again in 2 weeks with another analysis. Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on our next podcast episode and new investing resources. What are your takeaways and thoughts about this discussion? Let us know in the comments section below.